Hello everyone, my name is Reese, and in this video I will be talking about some of the pros and cons with ETF investing, as well as who this investing strategy might be suited for. So to start off, I'm going to be going over what is an ETF. So in plain terms, an ETF stands for an exchange traded fund. It can be traded on the overall stock market, such as you can be bought and sold through a broker such as Robinhood, TD Ameritrade, Fidelity, whoever your broker is. And what an ETF is, it is a composition of stocks in a single investment. So one ETF can hold several stocks, and usually they can track passive indexes such as the NASDAQ, um, S&P 500, or they can be actively managed funds that are trying to more aggressively potentially beat the overall market. Usually when you invest in an ETF, you are going to pay some sort of expense fee or management fee for the company to actually do all the work for the ETF. And ETFs are good for people who may not have the time and energy to do the research required to actually sort through individual companies to do their homework on seeing if a company might be worth investing or not in. And by investing in ETFs, it can help you avoid betting on individual winning or losing companies. So what that means is if you're a retail investor and you are investing in companies, you might not have the time and energy to really research every company out there, to really do your due diligence to understand what you're buying. And when you are choosing those companies you are investing in, if you're investing in a few companies, even if that is diversifying across different companies, you're more likely to, lose more money by investing in overall or managing your own portfolio rather than just passive investing a good index like an S&P 500 or total market fund. And there's been a lot of studies done that actually a surprising amount of even professional investors are unable to consistently beat the S&P 500. I think the rate was between 85 and 90% of all investors, including professional fund managers, were unable to, of 85 to 90% of fund managers were not able to beat the S&P 500 consistently long term. So it's always good to do your homework when you're choosing a fund to potentially invest in, because just because a certain index is outperforming the overall market in the short run, it may not do it in the long run. And then another thing with why ETF investing is good is timing the market can be difficult. You might, when you're investing in an individual company, it can be harder to really find a good time to get in. Whereas if you're investing in the overall market and you're kind of just dollar cost averaging throughout, and what dollar cost averaging is essentially just investing, let's say, a set amount per month or per week into the overall market so that you're riding out any downturns or upturns. So when let's say if you were to lump sum dump in the overall market this year, if you did that in January, you would have been down considerably. Whereas if you had been dollar cost averaging on the way down, your overall returns wouldn't be as painful. As well as when you're going up, once we start reversing towards an uptrend, dollar cost averaging on the way up is a great way to capitalize on those gains. And then another thing is ETFs are going to have built-in diversification. Rather than betting on an individual company or a few different ones, you are basically investing in multiple companies at once, whether you're investing in some sort of sector ETF such as energy or tech, or in some sort of growth value, total market, whatever it is. There's tons of ETFs out there that can help you meet your financial goals. And then historically, the S&P 500 has returned between 9.5% to 10% on average in the long run. So in the short run, the S&P 500 can be very volatile. It can have returns exceeding that, or it can have underperforming years. But if you history has shown that if you hold for a long time horizon, investing in something like an S&P 500 index fund can be a great way to see long-term wealth creation. And even Warren Buffett himself recommends that investing in simple, low expense ratio or low expense fee S&P 500 index funds is usually going to be your best bet for the average investor, especially if you have a long-term time horizon. And as I mentioned, there are several categories of indexes that ETFs can track. I use a website called ETF.com to do my screening myself. It's a good way to kind of just see what kind of sectors are out there, what kind of funds are tracking what. You can go in there, see what the expense ratios are, and you can see the assets under management. Now, I'm not going to go into how I pick and choose ETFs in this video. I'm simply going over some of the pros and cons associated with index funds. Now, getting onto the cons, I don't have a separate slide for this, but some of the cons with S&P 500 is you may not see the returns that investing in, you're less likely to blow up your account up or down. So if you had invested in, say, like Apple, Netflix, Google, some of these very high growth companies that we've seen dominating the market in the past 10 years or so of growth, the S&P 500 has lagged those companies overall. However, these companies, betting on individual companies in a downturn can really, it's like shooting dice, because you don't know which companies are going to outperform in the future just by looking at previous returns. And then index funds are going to have that expense fee, but it's good to do your homework. Make sure you're getting in an index fund that has a low expense fee, because having a high expense ratio is really going to start eating into your returns. And here is a list of some low expense ETFs that I think are good things to look into. And on the left, these are what I consider to be some of the best large cap, small cap, and mid cap ETFs out there that you can really, I'm not giving these buy recommendations. I'm saying these are ETFs that you should be aware of if you're wanting to get into index fund investing. And with that being said, this is VOO is the Vanguard S&P 500 index fund. It is not the only S&P 500 ETF out there. There are many other S&P 500, but VOO is very popular because it has a very low expense ratio. And VTI is the Vanguard Total U.S. Market Fund, and it is a composition of both all large cap, mid cap, and small cap stocks in the U.S. So it's very diversified in its approach, and it has a low expense ratio. Going off into mid cap, IJH is an iShares S&P 600, SCHM is a Schwab Dow mid cap, and VO is a Vanguard mid cap. So even though these are all mid caps, ETFs can track different indexes based on what they are meant to track, and you can learn more about looking up the individual ETFs on their own, seeing what they track, what their historical performance is, what their fees are. And then small cap, some popular ones that I think deserve at least a looking into are IJR, SCHA, and VB. So similar approach to the mid cap. These are going to have low expense ratios, and they're going to track different small cap indexes. And then going on the right, we have some dividend, growth, and value ETFs. So dividends, my personal top 3 picks for dividend ETF investing is SCHD, VYM, and VIG. These are some high-paying dividend growth ETFs out there that are great at what they are designed to do with low expense ratios and high volume. Going into growth, there are hundreds of growth ETFs out there. It can be kind of hard to really sort through properly, but I think some of the best large cap growth funds are going to be VUG, which is a Vanguard growth, a Schwab high growth, SPYG is S&P 500 growth fund, and QQQ is a popular NASDAQ 100 ETF. It doesn't include financial growth companies, so it's very tech heavy, and it has, I believe as of right now, it's like 53% of its total holdings are allocated to its just top 10. So the top 10 companies make up 53% of QQQ. And then some popular mid-cap growth or VOT, IWO, small cap growth, VBK, Vanguard growth, and similar to value. So by definition, dividend companies are usually going to be value, but so some large cap value are going to be VTV, SPYV, SCHV, mid cap, and small cap value shown on the right. So all of these are passively managed, low expense ratio, except for AVUV, which is, I believe, Avantis small cap value. And that has a 0.25% management fee, if I remember correctly. So it's actively managed. There is a fund manager. actively picking and choosing what companies are going in that index fund. So that's why it has a higher expense ratio. And as I said, these are not going to, I'm not saying that these are the absolute best ETFs out there. I'm simply saying that these are things that I think should be on your radar if you are wanting to get into ETF investing. And this is kind of giving you a head start on things that I think you should look into. So, in summary, ETF investing, it is a more passive form of investing. You're kind of setting it and forgetting it. You're buying these composition of stocks, and you can build a portfolio centered around ETFs to really make up the core holdings of your portfolio. Historically, overall, the S&P 500 has been a great long-term investment option to building long-term wealth. And you can add exposure to mid-cap, small-cap, or some tilt your portfolio towards growth or value depending on your personal risk tolerances and investment goals. And I personally, my personal favorite ETFs that I have set up in my IRA are VTI, Vanguard Total Market, IJH and IJR, which are the iShares mid and small cap. And then I use all three of the dividend ETFs that I listed because I believe that they offer good value for what they are targeted to do. The reason why I personally don't have dedicated growth in my newer portfolios is because half of the S&P 500 right now is growth. So adding an additional tilt to growth wasn't in my investment goals. So it really comes down to your own personal risk tolerances, as I said. And I don't think there's anything wrong with adding a tilt towards growth if that's what you believe in and you understand what growth companies represent. They're going to be a little more risky, volatile markets, but by investing in growth index funds, I think is a better option than investing in individual growth companies because you're getting that diversification by buying an ETF. So hopefully that all made sense. Like I said, I'm not trying to give certain buy and sell recommendations. I'm simply saying these are why I like ETFs. These are things that I think are helpful and why it can be a beneficial add-on. Now, if you are doing ETF investing, you don't have to. You can still pick and choose individual companies, but I think it's good to have a strong core holding, such as an S&P 500 or total U.S. market fund. There are going to be sector ETFs like an energy and tech, like I mentioned before, as well as bond ETFs, so I'm not going to get into that in this video. I can do another video where I talk about how I filter through and screen what ETFs I think, or the process I take on when I'm looking into what ETFs I want to invest in, but that'll be for another time, another video. So thanks for watching, guys. If you enjoyed this content or you want to see stuff like this in the future, feel free to like, comment, and subscribe. Give me some feedback. If you have anything to say, I'd be more than happy to take a look. Thanks for watching, guys. Hope you had a great one. Peace out.